Hello everyone, in this video we're going to be talking about the opening gap. So the opening gap basically means that the price of the opening price today is different than the closing price of yesterday. So if the opening price of today is higher than the closing price of yesterday, that means we're gapping up. Or if the opening price today is below the closing price of yesterday, we're gapping down. So like there's this one book called Mastering the Trade, John Carter. It's a book I have, an audiobook, and he basically says this is basically one of his favorite strategies is to play the gap, because most of the times these gaps fill. So if the opening price is below yesterday's close, then there's a high chance it'll fill. So in this video we're going to do two things. Number one, we're going to discuss this opening gap concept and do some analytics about how often it'll fill on certain conditions. And number two, I'll just show you how to do a simple logistic regression model to try to predict these gap fills. This is not meant to be a good model. It's meant to be very simple. And then if enough people comment, I will show you how to make a real model with real trading with interactive brokers to implement this gap play thing. So let's get started. Okay. So let me just first import things, make everything bigger, that sort of thing. Of course, this notebook will be available. If this video is helpful, please like and subscribe. This video is actually very useful. Not financial advice, but like gaps do get filled most of the times. Okay, the first part we're only going to use Yahoo Finance so everyone can run it, and then the second part I'm going to have to use interactive brokers because I want to have pre-market data to create the model of predicting if the gap will fill or not. Okay, so let's get started. So first, let's just show you guys the concept. To do that, let's get some data from Yahoo Finance. So if I do ticker equals yf.ticker, that gives you the ticker of Yahoo Finance. You give it a symbol like Tesla, and then you get the data by doing df equals ticker.history history period max equals max, gives you the full period. And then you can look at the data by doing df.head. Okay. So this is Tesla's data from Yahoo Finance. Let's ignore these things for now. If you don't do anything, it gives you adjusted close, so it adjusts for dividends. But in another video, a previous video, I spoke about that. But okay, let me show you guys a few examples of opening gaps. So first of all, just to remind you guys, this is kind of a very ugly chart of candlesticks because I'm using Plotly. But basically, a candlestick is either green or red. It's red if the opening price is above the closing price, meaning it went down during that bar, and it's green if the closing price is above the opening price. And the endpoints are just the max and min. So for example, if you look at this candlestick, you'll see it's red. That means that the open is above the close. So that means these 2 points, this will have to be the open and this will have to be the close. And then this will be the low, and this will be the high. And for a green candle, it's the opposite. The open is the lower one, the close is the higher one, and the high and low are the same. Okay, so let me show you guys a few examples. So number one is, let's say you have this day, since the red candle, the close is the smaller one, and then the day after you have you see that the open is higher than the close of the previous day. This means it gapped up. But as you see, the low of this candle is way below the close of the previous day. So the gap was filled. The gap already was filled here. And then as another example, if you look here, this candle, the close, since the red candle is below the open, and tomorrow the open is here and the close is here. But as you see, the open, it never was able to fill the gap because the high is here and that's way below the gap of the previous close. So it was never able to fill the gap. If it would have gone all the way to here, it would have filled the gap. Okay. And then just as another example, let's say you have a gap up. So the close of this day is here and then the open is way up here. As you see, the low is only here, so it's not even close to filling the gap. So the gap up never filled in this case. So those are just a few examples. Okay, so now I just want to show you guys like how to calculate these opening gaps and that sort of thing. I'm gonna do it as like a percentage. To calculate the opening gap, what do you need? You need the previous day close. So I'll write prev close equals df.close, it's Yahoo Finance, so dot shift 1. Okay, so we need that, the previous close. So then the opening gap would be df opening gap. Oops. I'll do the convention where I have capital letters at the start of each word, equals df dot open minus df dot prev close. Let me just do this actually, because sometimes when you have a keyword like time or whatever, it screws things up. Even though open is not a keyword with uppercase, previous close divided by the previous close. This will be the gap percent. Close. Okay, let's see how this looks. We can do df opening gap dot describe. So as you see, 50% of the time, like the average opening gap is like a little over 0.1%. The biggest gap was a 25% one, and the smallest was a negative 15% one. So this is just a thing to calculate the gaps. So now like we want to have like a gap condition. What does it mean to be a gap down? So a gap down means your open is above previous day close, right? So it also, this percentage basically would be less than 0, right? So gap down would be df gap down equals df opening gap at less than 0. And similarly, df gap up would be df opening gap greater than 0. And let's just add the case where the price is the same, at least to the nearest decimal. And this will be df opening gap equals 0. Okay, so this is where the there's no gap. So now let's just calculate the percentage. Oh, sorry. Percentage of the times a gap down is filled. So we need a gap down. So we need df dot. Let me first show you guys how this looks just for a second, because I'm going a little fast. Df gap down. So just be like a true or false type thing. So the percentage of the times a gap down is filled would be df that df gap down. So you need a gap down, and then what do you need for the gap down to be filled? Oh, sorry. Let's first. Sorry, I lost my train of thought. So let's first actually have a. Okay, gap. This is the gap condition. I'll call this gap type. It could be gap down, gap up, or no gap. And then let's do a new cell, and we'll call it gap filled condition. And so what does it mean for a gap to be filled? So for up gap, it means that you're above yesterday's close. So you need the low of the day to be below yesterday's close. Okay, so let's do that condition. So it would be df gap up filled equals df low less than df prev close. Okay, so this is the gap up filled. Similarly, for gap down filled, it would be you're below. You start below yesterday's close, and you go above it. So you need the high to be above the previous close. No, technically it would be greater than or equal to, but I like this stricter thing because it's a little safer. But you should do greater than or equal to. But anyways, okay. So now let's calculate the percentage of times a gap down is filled the same day. So that means you have a gap down and you fill it the same day. And this would be gap filled condition on same day, meaning during the day of the gap, you filled it. Okay, so let's do a percentage of the time the gap down is filled the same day. So we'll do something like gap down. Oh, oops. Should call it filled. Filled. And then let's do just dot mean. So 67% of the times the gap down is filled the same day. That's a pretty good odd. And then the gap up similarly would be, and this is why it's annoying when like a stock gaps up, it always goes down the next day. So the percentage of the time the I wrote here percentage of the time gap down of 2% or more is filled the same day. So let's actually do that. That would be something like df dot, we need a gap down. And what we need is, actually we don't need a gap down because the other condition will take care of it, but let's just write both anyway. Opening gap less than or equal to negative 0.02, that's 2%. And let's see percentage of the times it's filled. This would be the gap down filled dot mean. It's 32%. So even if you have a relatively big gap of 2% or more, down 32% of the times you filled. So it's probably often a good idea to buy a stock at that point. I mean, especially if you like the stock. And this is filled the same day. Obviously, it could fill like a week later. And then for similarly for gap up, we'll do the percentage of the times it's filled the same day. So I'll do gap up filled 67%. So it's a little bit, it's very similar. 67.29 and the other one is 67.0. And then we'll do a similar thing here where it gaps up over 2%, and let's see how many times it fills. So gap over 2%. Let's see how many times it's filled. Gap up filled. Ooh, nice 33%. Okay, so the gap play is pretty good. Okay, so now I just want to, for a second, let's make this general. And I don't want to spend too much time on this. So like, I'm just going to like say like, let's just say we have like a symbol, like you can give it like a symbol like SPY, get the ticker from Yahoo Finance, get the history. And let's just make a function. I'll call it, I already pre-did this, of course, get gap fill analytics, where you give it the data frame and you give it like an absolute percentage gap, like this would be like 2%. And then it'll calculate these stats, like percentage of the times the gap is filled the same day, percentage of the time the gap is filled, a gap of over apps percent gap is filled, that sort of thing. So this is what this thing will do. So as an example, because SPY is way less volatile than Tesla, let's say we have a gap of instead of like 0.2%, we do this thing and we see like, okay, the gap of 0.2% is filled 62% of the time. That's actually a really good win-win, by the way. If you get a 0.2% gap on SPY, let's say SPY is 500 a share, what's 0.2% of 500? That's not bad at all. So like, let's say 2% of 500 is 10, right? And then 0.2% of 500 is 2. So like you can make $2 on every 100 SPY you trade. Not the word, I mean, depends what your trading style is, but like the gap fill is a strong thing. And just for the hell of it, you can do a QQQ also. And this thing adjusts for dividends like as a default. Again, I have another Yahoo Finance video. I talk about this a little bit more. So for QQQ, it's interesting. I thought this would actually be a higher percent filled. Oh, okay, sorry, QQQ. So like, yeah, so QQQ about 60% of the time it fills 0.2% or above. When, let's say it's tanking-ish, like 1% or above, it still fills a decent amount. But like, okay, so instead of just relying on numbers, so this is just like basically like a gap analytics thing. But it's, oh, sorry, that's my actual software to record the video. Okay, but instead of actually relying on numbers, why don't we create a model to predict if we have a gap fill or not? This is not going to be a sophisticated model. It's going to be like very, very, very simple model. So like, if you want a sophisticated model, you should add like Better features, use many symbols together, that sort of thing. Maybe some macro data, like there was like a report. But basically the idea is we want to see if we can use like pre-market information to predict if the gap will get filled or not. So because the idea is like the gap is meaningful if pre-market activity is huge, and the gap is less meaningful if pre-market activity is small. So the huger is, the less likely to fill, and the smaller, the more likely to fill. Also, of course, we have we'll add it as a feature, the gap percentage itself, because obviously the higher the gap percentage, the less likely to fill. This is just a dumb example to give you guys a model. Again, if you guys really want, write a few comments about deploying this model with interactive brokers with IB in sync, or if you want to see logistic regression like in detail, or neural network, or a better model, comment. But like to deploy the model, please just comment. I will, if enough people comment, I will show you how to deploy the model. Okay. So just one last thing is this get gaps analytics, by the way. It filled extra columns, like it had a column called opening gap apps. That's the absolute value of the opening gap. So if the opening gap was like negative 0.03%, then it would just make it a positive. And then I have like, of course, the gap down, gap up, true, false, that sort of thing. Okay. So let's get started. So we need interactive brokers because we want 30-minute pre-market data. The reason I'm using 30 minutes is because like, I don't know, in general, like 9:30 to 4 p.m. It's like 30-minute intervals, like covers everything. And it's not too much data. Just a quick tiny side notes is like, you should be a little bit careful because sometimes there's like stock splits that can mess up your data, and sometimes like at 8 Eastern, if you haven't noticed, like there's some crazy price action, meaning like there's trades that do not match the bid and ask. So just be careful with these things. Take this with a grain of salt. Okay, so let me first show you how to get the 30-minute data and do this logistic regression thing. Okay, so first we connect to IB, of course. And soon I will have a, like, for beginners, IB in sync end to end. IB, okay. So now let's get historical data from IB. So we define a symbol equals, let's say Tesla. Let's do a contract equals stock. Symbol equals Tesla. Exchange equals smart. Currency equals USD. And then let's get the data. We do bars equals ib.rec. Historical data. Contract equals contract. End date time equals, this means until the current time. Duration string equals, let's do 2 years. If I do more in one go, it gives me a timeout error. So 2 years is good. 30 minutes. What to show, let's do trades. And then this is important, use regular trading hours is false because we want to use the pre-market data as our features. Okay, so once this runs, then I'll just remind whoever isn't familiar, it gives you like a list of bars like this, and then you can do you can basically do as a data frame by doing util.df bars, and this gives you a data frame. So it's like this. Notice that the date is not an index like in Yahoo Finance, and open, high, low, close, volume, average are all lowercase. Average, by the way, is the average price traded. So let's first let's get it to match Yahoo Finance. So let's capitalize to match Yahoo Finance. Capitalize and set date as index to match Yahoo Finance. So let's do that here. So how would we capitalize? We do df.rename um, lambda L dot capitalize, access equals 1. And then we'll do set index date. Let's see if this worked. Yes. So let's do df like this. Okay. So now let's get the date itself, because we're predicting on a day level. And remember I told you guys that we want to have like some sort of measure of how active trading is in the pre-market versus like usual. So one way we can do that is we can have like the volume of today, pre-market today, divided by the volume of like the average volume of pre-market in the last 14 sessions. But I like dollar amount. Like dollar amount would just be the dollar amount traded. So I would compare the dollar amount traded today to the average dollar amount in the last 14 sessions. So let's create this dollar amount traded thing first. Okay, so let's get started. So the day, just to remind you guys, if you guys are not familiar, if you have a date time index, you can just do dot date, and that gives you a day. So let's do it like that. We can do df day equals df dot index dot date. Okay, and the dollar amount would just be df dollar amount equals df volume times df average. It's the volume times the average share price traded. Okay, so now let's do two things. Let's calculate the open, high, low, close volume for market hours. So so I'll call this like df. I'll do this df market hours. I'll call it df daily because it's daily prices. Equals market hours. We do dot between time 9:30 to 15:30. The reason I do 15:30 and not 16 is this is inclusive, and then 15:30 would be 15:30 to 16, so the last 30 minutes of the day. And then we do we can do a group by day, and then we do the ag function. And then let's do open, high, low, close, volume. I added this numbars thing, but I'm not going to use it. Numbars will be the total number of bars. This is just a way like where you can filter like half days, like let's say Black Friday and things like that. But okay, so let's go one by one. Open is the first price of this group. So this would be open first. High is the maximum price. So it would be high max. Low is the minimum price. It would be low min. Close is the last price. So it would be last. Volume would be the sum of the volume in that interval, of the bars in the interval. So I'll do sum. And then num bars would just be a count. So I'll do volume count. Something like that. Okay, so now I have this df daily. It looks like this. I have like the day, and I have the open, high, low, close volume and number of bars. And then let's do the pre-market version, because we want to use those as features. So what is pre-market? It's from 4 a.m. Eastern to market open. So I'll do df pre-market equals df dot between time 4 to 9. Remember, you write 9 and not 9:30 because it's inclusive. So the last interval will be from 9 to 9:30. Group by day dot ag. And remember, we just want like relative volume and dollar amount. So we're going to need volume equals volume sum. And then I'll do dollar amount equals dollar amount sum. And then that's really all we need, because I'm pretty sure pre-market, like even for half days, is all the same. Ooh, what did I mess up on? Oh, over 2 lines you do like this. Did I mess up? Dollar amount does not exist. Oh, dollat amount, dollar amount. Okay. Is this better? DF pre-market. So just one quick note. Remember I told you about the num bars. If I were to do like DF daily, DF daily dot num bars dot value counts. Oh, it turns out everything is 13. Weird. Let's not take this seriously. I might have a bug here, because I thought there would be half days about like Black Friday and that sort of thing. But like, it's worth double checking. This is not meant to be perfect. Okay, so now I have the pre-market version. So the pre-market, I calculate the pre-market volume and dollar amount. So now let's do the relative volume dollar amount traded pre-market. Again, we're going to compare today to the last 14 days. So we can do something like DF pre-market volume average 14. That would be the average of the last 14 days. We'll do DF pre-market dot rolling 14 volume dot mean. And then for dollar amount, we'll do the same thing. Pre-market dollar amount average 14 equals DF pre-market dot rolling 14 dollar amount dot mean. And then we'll do DF pre-market volume to average 14. This will be the volume of today's pre-market to the 14-day moving average. So I'll just do DF pre-market volume over DF pre-market volume average 14. And then same for dollar amount. So I'll do DF, I'll call it dollar amount to average 14. I'll do dollar amount. I'm going to do dollar amount average 14. Dollar amount is not found. What did I mess up on? Amount. I wrote it as a full thing. Okay, so now I have the DF pre-market just to show you guys how it looks. The first 14 are gonna have missing values. So because like you don't have the mean for the 14. So first let's join the tables together. And we'll deal with the missing values in a second. So this would be like, of course, DF equals DF daily dot join DF pre-market. What do we need? Let's just take the last two as the features. We'll take these two. Okay, so now this looks like this. Again, the first 14 are missing values. So let's, of course, let's look at the gap analytics as we did previously. Let's see, now that we have daily levels, we can see that it still works. Like this gap analytics, plus that'll give us the labels we want to do for the machine learning. I'm not going to do train, test, val, all that stuff. I'm just going to show you like a very basic example to give you an idea. So like I can do like, and I didn't handle missing values yet. We'll do that in a second. Get gap fill analytics, DF, and let's do like gap fills of 1% or above. So a percentage of the time the gap is filled is 62.8, 67 for up gap, down with 1% is 45, up is 53, which is interesting because Tesla can never hold leads. So this is interesting. When it's up gap 1%, 53% of the times it'll get filled. So like when it's gapping up, everyone just dumps it, which makes sense if you've been suffering from Tesla. Okay, so let's drop the missing values, the first 14, of course. So I'll do a df. So let me actually do this. Let's only do gap. Let's only focus on gap downs, and let's see if the gap will get filled. Focus on gap downs and build model to see if gap gets filled. Why do you want to focus on gap downs? Because I hate shorting stocks. I don't short stocks. So let's focus on gap downs and see if the stock goes up enough to fill the gap. So gap down only, we'll call it df gap down. Gap down equals df dot gap down. What did I get wrong? Oh, sorry, it's called gap down. And then let's drop the missing values, those 14 values. Gap down dot drop NA. Axis equals 0, in place equals true. Okay, so now let's define features. So if we can just use like 3 features, like volume to average 14, like that's the relative volume, this is the relative dollar amount, and this is the opening gap, like absolute value of the percentage. And let's do the logistic regression model. So we can do, we can do classifier equals, by the way, these two are so correlated. I'm going to remove one of them soon because it'll just make the model look a little bit better. So I'll do classifier equals logistic regression. Do random state equals 0, just for good practice of reproducibility, even though it's deterministic, I believe. Df gap down, features, that's our X part of it. Did I not write this? Features. And then df gap down. The label is gap down filled. Okay, so this is the classifier. You get the you run it, and then you can fit it, like do dot fit. Oh, I already did dot fit. Sorry. We can look at the intercept and coefficient. You can do clf.coefficient and then clf.intercept. So this is interesting. Number one, the intercept is 1.57, which is a positive number, which means assuming nothing, you have a high likelihood of gap fill. And then all these coefficients are negative. What does this mean? It means like if the relative volume is high, or the relative like dollar amount traded is high, it's less likely for the gap to be filled, meaning the gap is meaningful because there's a lot of volume that proves the gap is meaningful. And of course, if the gap is larger, it's obviously harder to fill. So these all make sense. And I actually created this like personal function that will show the model as LaTeX. So like the model looks like this actually. It looks like probability of down gap fill equals 1 over 1 plus exponential negative 1.57 times 0.71 times, I'll call this relative volume. This is the volume to the average of the last 14 days volume. And then this is the relative dollar amount times 0.33, and then the opening gap absolute value of it. So this makes a lot of sense. It means like the larger the opening gap, the larger the dollar amount traded activity is, and larger volume traded activity is, the smaller probability of a gap fill, which makes perfect sense because if there's a big gap and there's tons of volume, like let's say after our earnings report or after like, I don't know, CPI or whatever, it's less likely for the gap to be filled. And then just for completeness, let's save and export the model. We'll use joblib because that's what sklearn does. I forgot to import it above, so I do dump clf, and then I'll call it gap fill logistic.joblib, and then I have the model, And then if I do file open, let's see, like I have the model last modified. Okay, I see a job libgib. Okay, anyways, this was the video. If you guys want to see this in real life with interactive brokers, give me a lot of comments and I'll do it. It's straightforward to do. If you enjoyed, if you're new, please like and subscribe, and thank you guys so much. Bye.